looking good. How are you feeling?
Yeah, good. Yeah, it's despite the market going up and down as it has been. Interesting quarter, just gone past, 6.6% down. Market was down 4.8%, but like a frustrating quarter. Like there wasn't as many opportunities coming up as we thought. Just felt like a bit more of a broad market sell-off, and then back up again, 4% for July. In a 1 month versus 3 month scenario, it's just been breakneck up and down. US recession seems to be sort of peeking its head up again.
Fascinating that that's now on the discussion.
Absolutely.
Before we jump into that, because we talk about recession risk all the time, that always comes up. But yeah, it was a really challenging probably 6 months to the start of the year, concluding FY24, but these things happen, and that's why people need to stay invested for 5 to 7 years, or we encourage them to. No one's locked up. That aside, obviously looking forward now to the quarter we're currently in. We're obviously in early August, and this week everyone's now talking about the risk of a recession in the US. Markets went into a bit of a panic, and then everyone's like, oh, hold on a second, maybe that means the Fed will cut. And then equities are back on.
Yeah, and then private credit will get kicked in the shins. It's funny how it all sort of rolls around. I mean, last financial year, we were ahead for the financial year up until, we did a Carlton. We were winning at 3/4 time and then dropped it in the fourth. We were just really close to a positive financial year, which, given the climate, we're pretty happy with. Yeah. And then all of a sudden, smack, and then you almost recover, not all of it, but a fair chunk of it in 4 weeks after that in July. So, yeah, it's bouncing around a lot. Obviously, you had Kamala take over from Biden, US elections coming, as we've talked about before. The Fed doesn't like traditionally cutting or raising interest rates during an election cycle, but they might have to.
It looks like they're sort of the guns to the head, so to speak. Which is probably not a great analogy for the US, but I should have picked a better one. They traditionally don't normally hike during the election process. That is, when they start to go to the ballots. I think the data we had was back to like 78 or 76, whatever that 4-year election timeline was. And every election year they've been active, cut or hiked, irrespective of 2012. They didn't do anything. But traditionally, very traditionally, it's normally not during the election.
During that actual blackout period.
The Fed, traditionally speaking, or theoretically speaking, is a independent body and needs to act accordingly without political influence. And if they have to cut in September, they might have to.
Which is one of those things, I mean, it's so dynamic. And then you get your favourite economist on Twitter, like they're going to say something, and then 3 months' time, the grounds that was built on have shifted.
Yeah.
So like we started the year, there was like 7 rate cuts are coming for the United States this year.
Yeah.
Then it was 5, then it was 3, then it was 2, then it was 1, then it was 0, then it was, actually we're going to hike. That hasn't happened either. And then we're back in cutting territory. And I mean, you and I talk about it a lot, the fear versus greed.
Just on the hiking really, really quickly. The hike conversation was like 2 weeks ago.
Oh, yeah.
And now no one's talking about hikes.
Now we're doing cuts.
Yeah.
And there's a recession.
Sorry.
But 2 weeks ago, jobs are good, hike has to come, inflation's being persistent. We have no choice but to raise rates. And now it's like the whole world's going to blow up, recession, everyone's going to, be out of, it's going to be the Great Depression, people lining up for loaves of bread. So the fear and greed piece is something we talk about quite a bit internally, looking at, what kind of climate are we in and how quickly it can go from extreme greed to extreme fear and then back the other way. You made a good point. I think it was last week or the week before last, that during the downturn of early August, retail investors sold off, I think it was $1 billion worth of stocks.
It was $1 billion worth of stock market value.
The instos bought $14 billion over the same time span.
Extraordinary.
So it's like they're buying the Boxing Day sale, effectively, and they have those ownership of those companies. They're going to have to sell them to someone else. They own them now. At some point in the future, they'll sell them. What's the chance that those companies, maybe in the next week the price might go down, in the next month or 3 months or 6 months, and maybe the recession will come about. But those instos that are buying and holding for 10 years, have had a field day. They've picked up something 10-20% off what they were willing to pay for it the week before that, and they're thinking, why not? Let's load up. It's like when your favourite biscuits on sale at Woolies. You'll buy 5 packets and chuck a few in the
Tim
cupboard.
Tams? No, not Tim Tams. Teddy Bear biscuits.
Choc Teddy Bear biscuits.
Sorry.
Favourite of my pop. So traditions hit hard on that one. I'm not generally too superstitious, but that is one I hold true. Choc Teddy Bear biscuits are good for you.
And always two.
Absolutely. Always two. One for me, one for him.
It is interesting. Market information is dynamic up until it's not. And if you started January this year to where we are right now, nothing's happened on the economic front. I mean, we heard sort of wavering jobs data and inflation data and all of the conversation, the hoo-ha about it, and the market's bounced around like this, really for no particular reason other than, to your point, fear and greed. It's just people's perception of what's going to happen. And I think often what happens is people forget that the market is often 9 months forward looking. So what's happening today is likely what they're expecting the market to look like in 9 months from now. That's a bit of a paradox.
In some instances.
Hoping. It's a massive hope. But the paradox in itself, I think, leads a lot of people to make brash, emotional decisions and throw the baby out with the bathwater, not realising that nothing's really actually happened yet.
No, well, the leading indicator of inflation is inflation expectation. So to put it in a very boring example, I guess, if the only food you could eat was bread and the loaf of bread's going to cost $1, and you hear that the loaf of bread's going up to $2 tomorrow, you'll rush out today and buy a lot of them at $1 because you're like, well, I'm going to assume the bread doesn't go off.
Should have said toilet paper.
Toilet paper is probably a good example. You go out and you hoard something that you're going to need in the future that you're like, I may as well buy it now before the price of it skyrockets. So people have rushed in to go, yeah, I'm going to buy that thing earlier. That increase in demand actually leads to the price going up. So inflation expectations cause inflation, which we've seen in Venezuela, Zimbabwe, and all the other different places. They've had those terrible spirals. And then you look at the other side of the coin. So you're going at the moment in the US, there's so much media push about, there's going to be a recession, everything's going bad. And you start to go, well, what's possibly the psychology behind that? If you look at maybe a darker angle, why is this narrative being sold so heavily against 2 weeks ago? Inflation's looking good, jobs are looking strong, everything's going hunky-dory, we're going to need a hike. I skimmed something the other day, so I don't remember the exact one decimal place, but I believe it was like 19% of US commercial real estate buildings at the moment are sitting vacant.
Yeah, that's extraordinary, that number.
So you say a recession's coming, everything's going to go really bad, people are going to be out on the streets, disaster scenario, all of a sudden people go, I'm really grateful to have my job. I like my job. I don't want to lose my job. The boss goes, you need to come back into the office. He's getting chucked down the street when this recession comes in 6 months, and all of a sudden the masses are going, I'm a bit more happy to go back to the office.
I'll do 6 days a week.
Yeah,
job,
sure,
right?
exactly right. Yeah, if it keeps you and your family and your children safe, you'll do anything. But people have had a really good time for a long time with the work from home, and there's been the push to 3 days, and some companies going to 5, and the job market looks good, all things considered. But yeah, you start to, not conspiracy theories, but they always have 1% of truth to them. If we've gone from here to here so quickly, and people have forgotten the narrative, what's the possible incentives driving that?
That's it. Now, last quarterly, we talked about a Hail Mary that we thought might be a talking point for the next quarter, which we're filming a review on, right? We asked...
Trump getting shot was not on the
radar. Well, no, it definitely wasn't.
Yeah.
I don't think anyone getting shot was on the radar. But we talked about the RBA. Did we think the RBA would have the courage to make a material move in markets, which we were suggesting would be a cut, not a hike, before the US did? Now, it seems pretty clear that the RBA is not going to do that, at least at this stage in mid-August, and we're filming. It's important to put the timestamp on it. But do you think now with the US likely to cut in September, do you think that, now we don't sit on the RBA board, but if you were to crystal ball it, do you think that might shift their view on where rates are at now that Big Brother the US might do something? Or do you still think we're early next year, which I think a lot of pundits are forecasting?
Yeah. We did say the Hail Mary last time that we didn't think they'd do it. That we said that there was a possibility they would, and that would be the outlier of something that would happen. So our base case was that it wouldn't happen, and we're not that ended up being the case. But we're trying to explore what would happen if that was the case. The composition of Australia and the United States is very different.
Yeah, we talked.
So you've got the top end tech focused in the United States generally, and you've got the big 4 banks taking up pretty much the majority of the market cap in the top 10. So they have different priorities there. There's less of an incentive politically to cut rates here, or economically by the independent body being the central bank, being the RBA. The Fed has more of an incentive to cut for a few reasons. One, they're in a lot of debt, so the interest expense on that is huge. 2, their tech companies have that future dated, we're going to generate revenue in 5 years, or we're going to sell this product. It's going to be working in 5, 10, 15 years. They're able to sort of R&D focus that longer term. When interest rates are at 50%, it's very expensive to do that. When interest rates are at 0, well, you go, well, it doesn't really matter when the payoff is. I'm lending you the money now, getting a return in the future. So and then everything in between that spectrum. So coming down the rate curve will be good for tech companies in particular, and then obviously the NASDAQ. Companies that sit within that index. So I think there's a good incentive that if you need to save the wealth effect, cutting rates in the US would be a very interesting one. Again, not to go back to conspiracy theories and whatnot, but how much independence does the Fed truly have if Trump gets elected? Who's going to be talking to who? Yeah. Influencing, not dictating, but influencing to say this is the direction the country's going to go in. If the US does it first, I think it'll give a lot of other countries room to do it, or do it more so. We've seen parts of Europe already start to cut. Europe, Canada, the Bank of England as well. Yeah. 1st of this month, 1st of August, they had a cut. So the developed nations are definitely starting to move, but you're right. I mean, that, and the fact that we've got
we're pretty much a mining currency and there's been low demand for our resources here, you start to think, well, at some point maybe the RBA is going to take it a little bit more seriously. Not that they're not taking it seriously, but look at it with more gusto as to what's happening at a
Hopefully
local
the
level.
Chinese start building some more stuff and buying some more raw inputs from
And
us.
they're having their own domestic issues, right? So you sort of go, well, who's going to be our knight in shining armour? Yeah, that's interesting. I just think it's worthwhile revisiting that we were. I mean, it was pretty easy to be right, but we were right that nothing was really going to happen.
Yeah.